Hello and welcome to the latest in the series of eValue's quarterly investment commentaries. This edition is for July 2017 and I'm Salman Ansari, a member of the asset team with eValue. Here we will look at how economic indicators have changed over the past quarter and how these changes are reflected in our asset model in the form of changes to returns projections. In places, we will also summarize what has happened over the past 6 months or so, and especially over the past quarter, and say a little bit also about where we think it is going next. Interest rates are the cornerstone underpinning asset price movements. We will start with these and then move on to the other assets. The main story this quarter is very much like the previous quarter, where actual market developments failed to match the amount of political news. There was a snap election called in the UK to help push through a so-called hard Brexit agenda. The election results, however, turned out to be rather unexpected, losing the government the mandate that they were seeking, and thus softening, or at least obscuring, their stance on Brexit somewhat. In the lead up to the election, Corbyn mania began taking hold, and markets reacted with weakening of the sterling. In the US, the Fed has raised rates twice already this year, and there are prospects of a third one at the end of the year. While in the UK, the Bank of England's Monetary Policy Committee came as close as it has in a decade to voting to raise interest rates, only for the governor to tell the market not to hold its breath while waiting for a rise. Manufacturing output has been weakening, and GDP growth is slow. The IMF has revised UK GDP figures both upwards and downwards in recent months, highlighting the uncertainty ahead and the challenge of predicting it. Political wrangling in the wake of the Brexit negotiations are only adding to this uncertainty, as even the government is failing to appear consistent and coherent in its approach. Brexit negotiations have begun and stalled as both parties have stiffened their stances and an impasse of sorts is developing. The political quagmire on the other side of the Atlantic is having its own set of economic effects. Recent strengthening of the pound is more a reflection of the weakening dollar than the improving economic prospects for the UK. Uncertainty in the UK is high as the economy faces inflationary pressures not apparent elsewhere, and there's also the threat of a significant shock to the economy. As we shall see later, in both equities and rates, the UK was somewhere in between the US and the EU this past quarter. So like the previous quarter, the picture is of the US moving in one direction, the EU in the other direction, while the UK does something in between. The news, though, is that the US and the EU have swapped roles. So as far as interest rates go, there are two opposite stories. Long-term US interest rates fell despite 2 policy rate rises this year, while euro rates rose, although this divergence materialized only in the last week of the quarter and is still small. US movements have been led by the bond market but are now being matched by fading expectations of further Federal Reserve policy tightening this year. The turnaround in euro rates over the last week or so in the period, in contrast, was triggered by comments from Mario Draghi. He was interpreted as suggesting an increased likelihood of reduction in the rate the ECB buys bonds, coming as soon as next year. So in light of all of this, we will have a look at interest rates. Rates in the UK have remained more or less unchanged this quarter, with a little surge at the end, taking it higher than where it started the quarter. The sterling leapt at the end of June, as Bank of England Governor Mark Carney hinted that growth would be a factor in an interest rate hike. In the US, rates have gone through a very gentle decline over the quarter, and the surge at the end failed to make it above levels at the start of the quarter. Like Britain, Japanese interest rates have also had a relatively smooth journey this past quarter. German and French rates, on the other hand, have had a more volatile quarter than the UK, and the spread between them has tightened significantly through the 3 months, signaling a possible reduction in market stress. The tightening spread is led more by the decline in French rates. Yields in Italy and Spain mirror some of their European counterparts, maintaining a near constant spread between them as they have done in previous quarters. Italian yields were even higher than US ones a few times over the quarter, indicating that the recovery is still fledgling. Greece has had some welcome news in recent times in terms of its debt management, and this can be seen in the steady decline in rates over the quarter. However, even though rates have dropped by well over 1% in 3 months, Greece is still out there with 10-year yields just under 6%. The upshot of all of this is that rates have nudged up slightly over the quarter, and we expect fixed income asset prospects to change and be slightly up this quarter. This is also a good place to remind our audience that in line with market conditions and expectations, the floor on interest rates in our model is set at -1% for UK, EU and Japan, but is at 0% for the US. Real yields are firmly negative, as we can see here, having finished up slightly over the quarter. The macroeconomic meaning of negative real rates is that either the expectation is that nominal rates will remain low or go lower still, or that inflation is expected to rise faster than nominal yields, or possibly some combination of the two. Although real rates have increased slightly over the quarter, they are still low, meaning that real returns continue to be hard to come by. When it comes to index-linked bonds, in the short term, index-linked bonds offer valuable diversification to bonds, especially in the absence of cash. However, in the long term, they are too much of a disadvantage, especially relative to corporate bonds. We'll next have a look at equities. We'll start with looking at equities in local currency. So here we have total returns indexes, not price indexes. Equities have had a volatile quarter when compared to rates and ended up generally higher except for EU equity, as we shall see. Volatility indexes shot up a few times this quarter, and as noted earlier, in both equities and rates, the UK is somewhere between the EU and the US. So as it is, we have a healthy but unexciting quarter for developed market equities. Asian equities have moved up more sharply than the others, and EU equities have in fact ended the quarter lower than they started. As noted earlier, the market's response has been modest in comparison to the political climate, and things like the calling of snap elections in the UK or its unexpected result appears to have had little effect on the equity prospects. Before moving on, we will have a look at exchange rates. The stock market movements that we've shown thus far were in local currencies. To see the effect on, say, a US dollar investor, we should look at these stock markets in a common numeraire. So let us first have a look at what exchange rates against the US dollar have been like over the period. Note that here we are showing exchange rates relative to their values at the start of the quarter and not actual exchange rates. The dollar has had a dismal quarter, weakening in almost every way we look at it. Political tumult and the inability of the US administration to push through its planned reforms has had pejorative effects. Job growth slowed over the quarter, although it has picked up somewhat since the quarter end. In relative terms, the sterling has strengthened against the dollar, but nowhere close to the euro, which has actually improved. So in terms of total returns, in US dollar terms, all other currencies have done better than the US over the quarter. The EU in particular has had the best quarter in US dollar terms, buoyed by the strengthening euro. In terms of prices, the story again is quite similar to the total returns indexes. The UK narrowly misses being the worst performing economy, owing to the late surge at the end of June when Mark Carney remarked on increasing interest rates on the back of persistent economic growth. The take home from the performance of equities is that although equities didn't do well enough to compress fundamental ratios, overall returns are up roughly in line with the rise in interest rates. We'll next have a look at property. We saw in the previous update how property was one of the victims of the post-Brexit vote period, as various property funds were suspended amidst a flight of capital as investors were worried about vacant commercial property. Some of this tumult has since been reversed, and property returns have improved since last summer. Although prices have begun rising, so have property yields, both of which help keep prospects from dipping. As we can see from this chart, pivoted at immediately post-Brexit vote, prices have only just reached close to pre-Brexit vote levels. Yields are rising faster, which combined have a positive impact on prospective property returns. For London, for example, the prediction for property is a 2% rise this year. Before moving on, we'll have a look at a few things related to Brexit and the economic effects it had. Brexit is and will continue to be dogging the UK's economic indicators for some time to come. The pound has had a rollercoaster year since the Brexit vote, and as we can see from the chart, in US dollar terms, the FTSE 100 barely made it back to the levels just before the Brexit vote at the end of the last quarter, although it has since surged past. Another effect of Brexit is rising inflation. An almost immediate effect of the weakened pound has meant that imports have suddenly become more expensive, which has applied upward pressure on inflation. We can infer break-even inflation from the spread between nominal and real yields, as we can see here. Until the Brexit referendum, the two rates moved roughly in unison, nominal rates being less volatile, of course. Post-referendum, however, the gap widened almost instantly, increasing the break-even inflation. Because of the convexity adjustment, break-even inflation generally underestimates inflation expectations. There are also other effects such as the liquidity of inflation-linked instruments, etc. As the pound devaluation continues to plague the economy, the widening spread between the nominal and real yields continues, and inflation expectations in the near to medium term remain high. Recent surges in the sterling versus the dollar have attenuated, if only temporarily, the rapidly rising inflation. This has also curbed break-even inflation, as we can see here. Now let's have a look at equity volatility. Equity volatility indexes are usually a good indicator of investor sentiment and market uncertainty. There have been several spikes in the VIX and VIX-like indexes over the past couple of years. For example, in the Chinese market collapse a couple of summers ago, and then again at the beginning of last year. And of course, the Brexit referendum last year. There was a surge again in April this year as the UK called for early elections, and the ECB hinted at an increased likelihood of a reduction in the rate of the ECB buying bonds coming as early as next year. However, more recently, markets appear to have calmed down, almost contrary to what one may have been expecting from quite an eventful quarter. The indexes have settled somewhat for the time being, but this could just be the calm before the storm. Finally, before moving on to our model returns, a quick mention of the Eurozone is in order. Like equities and break-even inflation, the Eurozone market stress, measured by the spread between the lowest and highest bond yields in the Eurozone, has been on the rise over the past year, peaking several times along the way. And like the equity volatility indexes, this has calmed somewhat over the past few weeks. So the summary of the last few slides is that while uncertainty is high, market volatility is almost uncharacteristically low. Inflationary pressures remain high, and the recent dip might be a temporary respite, as political and economic headwinds have not dissipated. Next, we move on to asset returns. The main take-home from the discussion thus far is that, with a few exceptions, prospects have generally improved for most assets over the quarter, but to varying degrees. Equities didn't do as well as rates in the last quarter because they failed to compress fundamental ratios, and overall returns are up roughly in line with interest rates. There is some relative movement in prospects, more or less the inverse of the quarter's relative performance. So US equities show a small relative improvement in outlook, while EU equities outperformed and therefore their prospects are depressed to a similar degree. An exception is the outlook for emerging markets, where fundamentals have more than kept up with strong performance over the quarter, and prospects continue to catch up with their developed counterparts. Property prospects have also improved, as we saw earlier. Outputs from our model reflect these observations in the asset returns projections. We will demonstrate these by way of tilt charts, like the one on the screen right now. These show the change in asset returns over the quarter at various time horizons. A movement to the right indicates an increase in risk, while a movement upwards indicates an increase in return. So the best improvement is in the top left quadrant, more return at the cost of less risk, and the worst change would be in the bottom right quadrant, more risk and less return. At the relatively short time horizon, in this case 8 years, asset returns movements are up and to the right, which is a small increase in risk for a sizable change in return. Property and emerging markets equity are the clear winners, with fixed income assets coming second. UK equity is the least improved. If we look at the longer term, 18 years say, the situation is again very much the same, except that property and EM equities returns are a bit better than they were at 8 years. Again, the UK equity return is the least improved. So in terms of allocation changes this quarter, we expect most changes to be driven by relative changes. In line with the modesty of the movement in asset returns, changes in asset allocations are not dramatic. The biggest changes come when US equity exposure can be substituted for UK equity exposure, either directly or as part of a diversified international allocation. So in summary, we will have a look at how the performance of the asset classes has changed over the past year. We can see that there has been a general increase in expected returns, while volatility expectations have not moved much, especially over the past 6 months. In summary, risk premiums are depressed and slowly changing. Inflation is likely to rise in the near term despite the dip last month, and real returns are increasingly difficult to come by. There's more uncertainty and market volatility to be expected ahead. Thank you for listening, and we hope to see you again next quarter. Thank you.